Okay, we are live. Abigail and Alex are here with us this morning to talk about the W-4 and what it is for. Take it away, Alex and Abigail.
All right, awesome. So, as she said, I'm Abigail Harper,
And I'm Alex Matthews.
and we are from the Low Income Taxpayer Clinic with Lewis and Clark Law School, and we're talking today about the W-4 tax form and how to inform you to be a more engaged taxpayer. We do have an exciting gift card raffle for our attendees, so thank you for being here. And we will throw in the chat the LITC email, and please just email you and your group that was in attendance, and then we'll reach out with the winner following this presentation.
Just let them know you are in Alex and Abigail's presentation or the W-4 presentation, just so you're entered for our gift card. Alrighty, and with that, we'll dive right in.
All right. Hopefully. There we go.
Okay, so first we're going to start with the basics, just for those of you who might not even know what a W-4 is. So what is the W-4? The W-4 is an IRS document that is officially called the Employee's Withholding Certificate. It's an extremely important document that the U.S. tax system uses. It's a form that your employer must have you complete when you're hired, and the W-4 basically allows you to tell your employer important tax information, such as your filing status, if you have multiple jobs, the amount of tax credits you're entitled to, other sources or amounts of income, any deductions you're entitled to. And all this information basically tells your employer and the IRS how much to withhold from your paycheck each pay period. That's going to go towards your federal income tax that you're going to owe at the end of the year when tax season comes around. Why do you need to worry about the W-4 and the federal income tax in general? Well, the W-4 can help determine the amount of the tax that to be withheld from your wage or salary throughout the year. The form has you input the information to determine what federal income taxes should be withheld from your wage or salary. And it may seem like an inconvenience to have your paycheck reduced by federal withholdings, but this is not only a necessary thing to do, you're going to have to pay taxes regardless, but it's important so that you don't end up with a giant tax debt at the end of the year when tax season comes around. And having your taxes withheld throughout the year may even entitle to a refund when tax season comes around. So if you are working, you most likely already have filled out a W-4. And if you don't remember completing one, likely your employer still filed one for you. Under this circumstance, your employer will just withhold federal income taxes as if on the very basic level. So single, or if they know you're married filings separately, and they probably didn't allow you any credits or deductions or anything else. So it might not be completely accurate if you didn't fill it out yourself. Who needs to worry about this? You. That's why you're here attending this presentation, hopefully. It's if you work, that is. If you work, then this affects you. Then you, like I said, you have to fill this out. Every employer must fill this out for their employer. However, there is kind of a caveat. If you are solely self-employed, you obviously are still working, but the W-4 might necessarily not be the totally applicable form for you to fill out. So if that meets you, we're not going to dive into that right now, but just note that if you are self-employed, there's some other things you might need to have on your radar. When do you need to fill it out? The W-4 must be filed with your employer when you start a new job. As I mentioned earlier, if you didn't fill one out, your employer likely did for you. You do not need to submit a new W-4 when you have to take on a new role or job within the same company or for the same employer. It's only when you move to a new employer, so your employer should have one on file for you. And although you only need to complete the W-4 when you're initially hired, it's a good idea and good practice to review your W-4 annually, so every year, to make sure your circumstances are still the same and you're having the correct amount of tax withheld. Things can change in a year. You can have a child, get married, have another source of income, so you just want to make sure that that's totally up to date. And so when tax season comes around, you'll be adequately prepared for that. And additionally, if you have filled out a W-4 with your employer and need to make changes to it, you are legally entitled to do so. And your employer must put the changes into effect no later than the start of the first payroll period ending on or after the 30th day from the date that the employer received the revised W form for you. So you're entitled to change it, and they have to put it into effect within basically 30 days from receiving that form back from you. And I think no, where most likely your employer will provide you a copy of the current W-4 for you to fill out. Sometimes they don't, so we also provided the link where you can find it, or if they sent it home with you to fill out and you lost it, your dog ate it, whatever, you don't want to ask for another one, you can find it here. And also, if you have the form in English but you prefer it in another language, the IRS offers its services, forms, and websites in several other languages, which I'll talk about in a moment. But also you can access it through that link to find it in a different language.
Okay, so we're going to set the scene a little bit with the W-4. So in 2020, the W-4 went through major changes due to some new tax laws being implemented. So we're going to go through that. Moving on. So as you can see, we wanted to compare the old W-4 that you see on the left with the new W-4 on the right. And so with this slide, we're going to go through some basic definitions that I'm going to reference in these changes so you understand what's current now and what was removed and how that implicates you. So first, you're gonna hear a lot about tax deductions. So these are the amounts that you can subtract from your income so you don't pay tax on it. So in turn, this lowers the tax you owe. So for example, this includes the standard deduction, which is the specific dollar amount that reduces the amount of income on which you're taxed based on filing status or mainly based on your filing status and whether you can be claimed as a dependent. So the standard deduction each year is adjusted for inflation. And for example, so for 2024, the standard deduction for single filing status is $14,600. The tax withholding allowance, you'll hear me talk about that. That's the amount that reduces the money withheld for federal taxes. And these were based on personal exemptions, but as we'll see, these got changed a little bit due to tax laws. Again, personal exemptions, a taxpayer could claim these for themselves, their spouse, and their dependents. That would reduce taxable income by that amount. And when these were in effect, it was around $4,050 per taxpayer, or per taxpayer, per spouse, and per dependent. So with all of that information, we're going to set the scene for these changes to the W-4. So in late 2017, the Tax Cuts and Jobs Act became law and significantly turned things upside down tax-wise, including how the federal income tax system operates. It eliminated withholding allowances, like we just talked about for taxpayers, adjusted the tax tables, removed personal exemptions and dependency exemptions, and in turn increased the standard deduction, and then made this child tax credit more available. So these changes in the tax law did not work well with how the previous W-4 operated. And so the old version determined withholding amounts based on the number of allowances you elected, in addition to additional amounts to be withheld. And since these allowances systems were tied to the exemptions, and since the exemptions were eradicated, then one's withholding amount wasn't as accurately determined. So the IRS decided to shake things up. And so we'll see what changed here. So until 2020, fun fact, the W-4 had not been changed since the 1980s. So the IRS made these changes in the name of simplification and accuracy. But as we'll see, the question is, how successful were they? So this form allows you now to file as head of household. The form, as I mentioned, removed the section for withholding allowances and now mainly focuses on withholding based on filing status, multiple jobs and other income, or if one's spouse works. The form also removed the obviousness of claiming exempt from federal withholding. And as we'll see, this might not have been the worst thing because there are some key implications if you claim exempt and you're not actually. So we'll get into that a little bit later. So is there anything the same? As we'll see, you still need to provide basic information like your name, address, filing status, and your social security number. And yes, you can still technically claim exempt, but as we'll see, they removed the obviousness of that, and we'll explain the dangers later on. Okay, so as we move, now we're going to go step by step through a W-4 and really go into the nuts and bolts of how you can be an informed taxpayer on the front end with this employer information.
All right, so we're going to start with the heading, which you can see at the top of the screen here, which doesn't require anything from you, but is important to note. So as Abigail said, the IRS publishes a new W-4 form every year, sometimes with changes for the previous year. So you always just want to make sure that you're filling out the form for the correct year. The year will be up in the top right-hand corner of the form. So just make sure before you start filling it out, you are filling out the correct form. And as I mentioned earlier, the form and IRS services in general are offered in several languages besides English. These include Spanish, Chinese, Korean, Russian, Vietnamese, and Haitian Creole. And as the form specifies, once you've completed it, return it back to your employer. Do not send it to the IRS. And there is an instruction sheet that goes along with the W-4, as you can see, but that's why we're here today, to hopefully make it a little easier and more digestible and ready to understand.
All right, so diving into step one. So this is entering your personal information, and as you might think, it might be some of the more basic information, but as we'll see, it can get a little, even here, you can be an informed taxpayer. So you must turn in must submit your first and last name. And so here you need to fill in your legal government name as reflected on your ID or social security card. So you can't use your favorite nickname, unfortunately, because the IRS doesn't know what you like to be called. The social security number, so you cannot use your individual taxpayer identification number. Your residential address where you receive mail. And then also here is where we will get into the filing status. So you will elect which filing status you would like to be under. And this is where it can get interesting. So the filing status is an important decision. It directly impacts how much tax is withheld, i.e. taken out of your paycheck. And it also determines your availability or limitation of certain credits and deductions. So as we'll see, sometimes you can be strategic with your status and then other times you're just single. So for example, taxpayers filing single typically pay at higher rates than taxpayers who are married. However, in some instances, married people can file separately. So we'll just see how that can interplay. So as we'll see, some taxpayers are eligible for more than one filing status. And when this is the case, you'll typically elect the amount with the lowest tax rate that you're eligible for. And so we're here today to determine the eligibility of each filing status. So single filing status, so you're single for tax purposes if on the last day of the year you are unmarried or legally separated from your spouse, and you do not qualify for any other filing status. And this typically means you qualify for the lowest standard deduction. Moving on. So here we have married filing jointly. And so you are eligible for this if you are married and both you and your spouse agree to file a joint return. In this regard, what if you just got married? What if you're happily newlyweds? So be aware if the couple is married as of December 31st of a tax year, the law says that you are married for the whole year for tax purposes. So how does this affect your W-4? So per the IRS, after getting married, newlyweds can check in with each other and consider changing their withholding. And if you want to change status, then as Alex said, your employer will have to submit that to your employer, and then they recognize that new filing status. So this can be helpful if both of your spouses work or both of you work, and it just works out better tax-wise for you to file jointly than rather married filing separately. We linked both the tax withholding estimator and publication 505, which are very helpful resources to really get more concrete information about how filing jointly could look for your situation. Here we have married filing separately filing status. So you're eligible for this if you're married, but you only wish to be responsible for your tax liability, or this method results in less tax taken out than the married filing jointly status. So once you are married, though, you are no longer eligible for single status. And so once you're married, it's either married filing jointly or married filing separately typically. Head of household is a new, as we said, is a new choice for filing status on the W-4. So you're eligible for this status if you are unmarried and or considered unmarried on the last day of the year. You paid more than half the cost for keeping up the home for the year. The qualifying person lived with you in the home for more than half the year. And so there are exceptions to this timing requirement, such as temporary absences due to school. So that's just one example. And in this regard, the person living with you has to be a qualifying person for this purpose of head of household. So typically this means a qualifying child or a qualifying relative. So some key points is that dependent parents do not have to live with the taxpayer in the home. Qualifying children must be under 19 or under 24 and a student. And we actually found this really helpful chart on this following slide that points to, that lays out how to determine if who's living with you can be a qualifying person for head of household status. So the qualifying surviving spouse filing status is also another one you can choose. And you are eligible for this status, but if you're eligible for it, you can only use it for 2 years prior than your spouse's death. So in terms of the requirements to pick qualifying surviving spouse, your spouse passed away. For the year that your spouse passed, you filed or could have filed a joint return. You did not remarry during the 2 years after your spouse's death. You have a child or stepchild you can claim as a dependent. So in this case, foster children do not qualify. The child lived with you all year except for those temporary absences, and you paid more than half the cost of keeping up the home. And so in this regard, we can see how they're meshing the qualifications for head of household with the qualifying surviving spouse in terms of some of these requirements do overlap. So the benefits of this is that you basically obtain the tax benefits as if you filed married filing jointly, which typically resolves in like less taxes taken out. For the year that your spouse dies, however, you can still file that joint return. So this filing status will apply 2 years after the year that your spouse passed away.
All right, so moving on to step 2 of the form. Overall, this step helps to determine the amount withheld for the job that you're filling out this W-4 for, while factoring in any other jobs or sources of income to make sure that you're being appropriately taxed with considering all your income. So not everyone has to fill out this step. Only fill out step 2 if you personally have more than one job, or if you're filing jointly with your spouse and your spouse also has one job. So the form lists 3 options for how to proceed under this step, A, B, and C, as you can see. Under subsection A, you can use the estimator that they provided through the link there. If you or your spouse filing jointly have any self-employed income, to figure out how to factor that in. Under subsection B, you can use the multiple jobs worksheet, which we'll talk about in a moment, to determine which jobs W-4 to fill out. And under subsection C, you can check this box if there are only 2 jobs total for you or you and your spouse. However, you must be sure to check this box on the W-4 for the other job that you're factoring in, whether it's for you or your spouse. Okay, so what does all this mean? So what you need to know is that basically if you're someone who needs to fill out this section because you do have more than one job, or your spouse who you're filing with also has a job, you need to consider the following. If you have 2 jobs, fill out section 2 through 4 on the W-4 for the higher paying of the 2 jobs. and leave these sections blank on the W-4 for the lower paying of the jobs. If you and you or your spouse have a total of 2 jobs and make roughly the same amount at both jobs, you should opt to check box 2C, which I talked about before. Just make sure that you're checking it for both W-4s that you're filling out. And if you are someone who, oh, sorry, did I already do this one? I already said that one, but so if you're someone who has 2 sources of income, or you have 2 sources between you and your spouse, and you don't want your employer to know that you have another job or another source of income, that's totally fine too. You can report this income under section 4, line C, which Abigail will talk about later. But on line 4C, the box is titled extra withholding. So you can just kind of calculate how much you expect from that and factor it in there. That way you don't have to disclose to your employer that you have another job. It's just shown as random income. So you don't have to tell them where it's coming from. And you basically just you have to know how much the amount or the income or wage is going to be, though, because you have to put in the dollar amount that factors in how much extra that your employer withhold from this federal tax withholding to factor in your other incomes. And so if you're still not comfortable with that and you don't want to put anything on your W-4 to let your employer know, the other step you can do is factoring in your other income outside of the W-4, and then calculating how much tax will be paid on it. And then you can just send the IRS directly periodic tax payment installments throughout the year. That would just require a little more work on your part. Whatever the case, you must report all of your income, though. So just remember that just because you're not putting on the form doesn't mean they won't know about it. It just might mean taxes will be a little more complicated for you. So make sure you're reporting all of your income to have proper withholdings throughout the tax year. And just as a brief reminder, what is considered income? So what we're talking about mostly with the W-4 is on the top left portion of the screen, which is wages and employee benefits. So this could be from goods or services you sell online, a freelancer, independent contractor, rent you receive from property, royalties, things like that. But it can also constitute other things, such as some scholarships, court awards and damages, alimony payments, benefits to you. So you might need to factor in a retirement plan, unemployment benefits, life insurance, things like that. And then also businesses or investments, things, dividends or stocks or anything you might receive from that. You want to double check that if you do have any tax obligation for them, just to make sure that that's all being counted towards having an accurate amount withheld throughout the year. And then this is 2B, which I referenced earlier. And this basically just helps you figure out how you plug in your information from the other job for you or your spouse, and it'll give you an income an amount that will help you determine how much to have withheld from this W-4.
So as we'll see, this 2B worksheet also factors in this fun numerical graph, which can be very overwhelming. I know at least it's overwhelming for me. So we actually have a fun hypothetical to walk through just how this tax table can work and how you can calculate the correct amount of income to withhold or additional income to withhold. So in this fun hypothetical, Alex and I are happily married, filing jointly. I make $60,000 a year and Alex makes $45,000 a year. So since we're filing jointly, we'll go over to, and since I have the higher paying job, we'll go to the higher paying job row. And so we'll see the top table is what we're working with, and you'll find the 60,000 wherever that falls into. And then you'll go to the lower paying job column and you'll find where that spouse's job falls in line. And then you'll meet in the middle and we'll see that we meet at $3,890. And so this does not mean that's going to be taken out of the paycheck or anything, but as we'll see from 2B, we have to determine the pay periods from the highest paying job. In this regard, in this hypothetical, I get paid monthly. So I would divide 3,890 by 12. and then will result in about $324. And so that's the amount that is calculated to accurately withhold from this higher paying job.
Okay, now on to step three. See how easy it is. We're just blowing through
Yeah.
these exciting steps. So step three is where can be exciting for you because it's where can possibly decrease the amount that you'll owe at the end of the year through claiming dependents or other tax credits. However, just as a disclaimer at the beginning, there are income limits. So if your annual income will be $200,000 or less for an individual, you can claim these. Or if it's $400,000 or less for if you're married and filing jointly, then you can claim these. If it's above either of those two amounts per your filing status, you unfortunately no longer qualify. So just keep that in mind. But who exactly is a dependent? So who are you claiming during this portion of the W-4? According to the IRS, a dependent is an individual who must meet the following qualifications. So a dependent must be a U.S. citizen, resident alien, or national or resident of Canada or Mexico. A person can't be claimed as a dependent on one or more tax return, with very rare exceptions, which we won't go into now, but I've linked on the slideshow if you're curious. A dependent can't claim a dependent on their own tax return. You can't claim your spouse as a dependent if you file jointly, and a dependent must be a qualifying child or qualifying relative. And I'll break down further what that means because those have their own set of qualifications to meet. So to be a qualified child, a child must meet the following requirements. There's relationship, age, residency, support, and joint return. So for relationship, the child must be your son, daughter, stepchild, eligible foster child, brother, sister, half sister, brother, step brother or sister, adopted child, or a child of one of these individuals. They also must be under the age of 19 or under the age of 24 if they're a full-time student, or they can be any age and qualify if they're permanently and totally disabled. They have to live with you for more than half of the year, which once again, there's some exceptions, but I won't go into those. And then they have to get more than half of their financial support from you throughout that year. And they cannot file the dependent or child cannot file a joint return themselves. So basically the child can't be married filing a joint return and then also be claimed as a qualifying child dependent by you. And then in addition to children, the IRS also allows relatives who meet the following requirements to be claimed as dependents. So they're not a qualifying child, so isn't your qualifying child or the qualifying child of another taxpayer, which means they didn't meet the qualifications in the last section. But they are a member of your household or have some sort of relationship with you like that. So they have to live with you for the entire year as a member of your household or be a specific type of relative. Their gross income has to be under $4,700 and they have to get more than half of their financial support from you. And then they can be claimed as a dependent on that form as well. And basically under this section, if the dependent is a qualifying child, you get a certain amount of credit for each of those dependents. So for 2024, you get for each child under the age of 17, you get $2,000 credit for each of those children that qualify. And then for individuals or other qualifying dependents, you are entitled to $500 for each qualifying person. These individuals can be children under the age of 18, which weren't claimed or qualified under the previous section, or under the age of 24 if a full-time student, and as I said, or any age of permanently and totally disabled. So $2,000 for a qualifying child, $500 for any other relative. So depending how many you have, it can drastically reduce the taxes that you are obligated to pay at the end of the year. And then also just to flag under this section, there are other types of credits besides dependents that can reduce your taxable income or the taxes that you owe. So under this section, you can also report any other credits that you are likely or that you know you'll receive or entitled to. And this will be just something that you should know if you are entitled to. So these things could be like an earned income tax credit, a foreign tax credit, an adoption tax credit, things like that. However, also note you can also choose to not claim any dependents on your W-4, even if you have them and know you'll be entitled to deductions or credits at the end of the year. And this will reduce your tax bill further at the end of the year because you'll be having more withheld throughout the year, not factoring in these deductions and credits. And then once you put them in, you could receive a larger refund back at the end of the year. So totally up to you how you want to do it, but just know that these could be possibly reducing your taxes owed in the short term or the long term.
All right, moving right along to step number 4. So as we'll see, it's denoted as optional. However, these other adjustments can really affect, you can be very proactive in your withholding. And here it's just always good to be aware of all the information presented to you. As we can see, things can change from year to year. You can get married, have a child, get divorced. So things are always moving. Life never stops. So we're just gonna go through all of the information for the W-4. So as we'll see, let me just go back really quick. We have 4A, which is other income not from jobs, 4B, deductions, and then 4C, extra withholdings. So we'll go through each of these and explain what these are and what it can look like on the W-4. So step 4A is other income that is not from jobs. So what does this mean? So it can include interest, dividends, capital gains, or retirement income. So as we'll remember from what Alex mentioned about what is income, this is where it kind of comes into play with the W-4. So choosing to report this information now can help avoid owing taxes on this income when you file your tax return. But it's important to not conflate this area from where you include any income from a job or self-employment for this section. So step 4B, these are fund deductions that we'll talk about. So this is also optional step that allows you to account for certain tax deductions you're eligible for. So nearly 90% of taxpayers claim the standard deduction. And as we'll remember from the definition section in the beginning, but we'll just quickly run through, this is a specific dollar amount based on your filing status that reduces the amount of income on which you're taxed. But if you expect to claim deductions other than the basic standard deduction, so this would mean that you itemize your deductions, this step will apply to you typically. So you may decide to itemize if your expenses that are deductible will be higher than the standard amount, or you are not eligible for the standard deduction. And unfortunately, certain groups are not eligible for the standard deduction. But however, to itemize, you will need to keep track of what you spend during the year in order to maintain documentation. So as we'll see, and the W-4 points you to the worksheet on page 3 to determine how to accurately itemize your deductions. So here's we can see you estimate the itemized deductions, then you compare it to the standard deduction, and then you kind of go through and see what this would look like taking a different deduction than the standard one. And then once you get that amount, you would enter it in step 4B on the W-4. All right, so step 4C, this is extra withholding. So here you report any additional amount of money you would wish to withhold from your paycheck per pay period. And when I saw this, I'm wondering, okay, why would anyone want to do this? So one reason is if you have multiple jobs or other sources of income, like we talked about in step 2, that would go into this line on step 4C. You can also do this if, say, your spouse doesn't withhold anything from their payments that they receive. You can take that on and account for it on your W-4. So entering this amount will decrease your paycheck. However, it could increase your refund that you receive after filing your taxes. And so some people do this just as a way to help their budget. And instead of going a line item budget, they just account for a specific amount to be withheld each pay period, and then they'll get that back at the end of the year. So it's just another way that sometimes people budget. So this area is also where you will claim exempt if you qualify. So per instructions, if you qualify as exempt from federal withholding, so this means that no federal withholding will be taken out of your paycheck. So you will write exempt below line 4C. But you will also need to fill out steps 1A, 1B, and step 5. However, here we're going to get into certain warnings about claiming exempt and what that can mean on the back end if you truly are not exempt. So to be exempt, you must satisfy 2 conditions. So you had no federal income tax liability in the past filing year, and you expect to have no federal income tax liability in the current year. So to have no tax liability for the past filing year, you didn't have to file a return because your income was below the filing threshold typically. And so an example is you probably didn't work last tax year, and this year you have your first part-time summer job at the local PetSmart. However, what happens if you end up claiming exempt, but you aren't actually? So if you put exempt and you really aren't, you will definitely have a huge bill waiting for you when you file taxes because no federal income tax has been withheld from the paycheck. So you may love it in the short term, but in the long term, it's going to catch up with you. Also, knowingly claiming exempt when you're not can be seen as a form of tax evasion. So this isn't a smart way to temporarily change your W-4 to exempt to just get more out of a paycheck to pay for that vacation you really want, and then change your W-4 later. In this regard, the IRS will see this as evading certain tax obligations you have as a taxpayer, and that can have serious implications. So as we can see, our advice is when in doubt, don't claim exempt. And if you truly are, then you'll get certain refunds when tax season comes around. So here we are, last but not least, we have step 5. And here you have to provide your legal signature and date the form. So this is the other required field on the W-4. So you must sign and date the form, leaving the employer's information below that line blank for them to fill out. So you sign this under the penalties of perjury. So this means that everything before that you filled out is to the best of your knowledge correct and truthful. And it also denotes that the form is not valid unless you sign it. So if you don't sign it, you'll have to go through all of this fun stuff again. And then also, as Alex mentioned, return this back to your employer, not the IRS directly. But what if I made a mistake or I realized something changed? So if you realize you made a mistake, whether prior to or returning the form, you can fill out a new updated W-4 and then turn that into your employer. And as we said, the employer will then recognize that new W-4. However, it's helpful to try to find these mistakes early on, because if you wait until tax season or later, certain penalties can accrue, and then also it's just better to accurately withhold throughout the year just to be more informed. So in order to highlight some mistakes or how to keep an eye on that, you'll just look at your paycheck, and if it's a lot bigger than you thought or a lot smaller, go back to the drawing board, go back to the W-4 and reevaluate your filing status and if anything has changed since you last filled it out. So overall, despite the apparent simplicity of this form, it really is a powerful tool to be an informed taxpayer, a proactive taxpayer, and yeah, to have just an active role in the tax system throughout the year. So to prevent the feeling of whether the IRS is just in your pocket, in this regard, we can see how we can be an active role in getting the most out of our paycheck while being great taxpayers. And we're just going to go through just kind of what the W-4 in practice looks like. So we'll start with the paycheck. So as you'll see on the earnings side of things, you'll see the rate, hours, this pay period, this, and then the year to date. So you'll see that the employee received about $918 for this pay period, and the year to date is the amount that they've made with that employer for this tax year. As we'll see, then we go back to federal income tax, and you'll see that about $27 was taken out of the paycheck for this pay period. And that reflects the filing status and everything that you filled out in the W-4. It's been calculated, and that's the amount that comes out of this paycheck. Then we'll see from year to date, this is the amount of federal income tax that's been withheld through this year with this employer.
Then just the next kind of evolution in the W-4 at work would be your W-2 that you get at the end of the year from your employer. And that'll show, as we've circled on the screen, exactly how much has been withheld throughout the year. So as Abigail was saying, the paycheck will be each pay period. You can see how much, and then you'll get this to show how much has been withheld in total throughout the year. And then
sorry, one thing, just the W-2 will come from your employer. And so this will be, the total amount of federal income tax.
And then the last kind of area where you will see it at work is on the actual tax return. So this is the first page of last year's tax return. Where you will put this information will be on page 2 under section or 25A forms W-2. And so that's where you'll put that amount that we've circled on the last 2 forms about how much has been withheld throughout the year. So this is the fun part when throughout the year, the IRS has been withholding money from you. Now you'll be happy you did it throughout the year. This is your chance to celebrate because this is where you put in that number and it will directly reduce the amount of taxes withheld. If you filled it out strategically, like we've been talking throughout the presentation, you likely won't owe anything or might even be entitled to a refund. Whatever the case, it's better to have some withholding, and because at the end of the year, it ultimately is just less that you'll have to pay. So a good tool to keep in mind.
All right, so that's what we have for you today. Thank you so much for tuning in. I think we have a little time if there are questions in the chat, or I don't know really how that works with Facebook Live, but again, if you attended and want to enter the gift card raffle, it's $15 to Dairy Queen. And so just email the LITC email, which should be
Professor Laura should put it in the chat for you.
Yeah. And so then email that, let us know that you tuned into the W-4 talk, and we will contact you if you win. Thank you so much.
Thank you.
So there were a lot of different questions in the chat, and they were all excellent questions. I tried to handle them as they went, but I will briefly go over them. We had a really lively chat, so thank you so much to our viewers for being
awesome.
present. So one of the questions was, what is the benefit of withholding extra income? And you did go over that in the presentation. I mentioned that you may want to, for example, if your spouse with whom you file jointly does not withhold, or if you have side jobs where there isn't automatic withholding, you can use the W-4 as a tool to account for that extra income. You had a whole slide on that, so I think that we answered that question in the presentation as well. Great question. There was another question about selling items on Facebook. So it said, let's see. If you sell something on Facebook Marketplace, do you need to report that as income? Or is there a limit to when selling goods online becomes reportable? And I said that if you're selling a personal item, usually you're selling it at a loss, so you wouldn't need to report that on your return. But if you're selling inventory for a profit, you'd report the profit on your return. There's a lot of IRS guidance that says, for example, if you have a garage sale, or if you're just selling your personal belongings, that really doesn't need to be part of your return because you're usually selling things at a loss. And then there was a question about whether qualifying dependents need to have Social Security numbers. And I mentioned that if you're qualifying for the child tax credit, the child must have a valid Social Security number. However, with the other dependent credit, the person does not need to have a Social Security number. And then another question about ITINs was that does having an ITIN affect the taxes you'll pay? And can you still get credits or deductions? I said this is a really complicated question um, because there's a lot of different rules around who can get what credits based on whether you have an ITIN or a social security number, but that in general, for the earned income tax credit, taxpayer, spouse, and child all need valid social security numbers, but for child tax credit, for example, just the child needs a valid social security number. We got a comment that there's 14 high schoolers watching on this end, so yay,
Oh
thank
my gosh,
you.
yay!
We are so excited to have you. Let's see, were there any other questions? So yes, if you want to answer email us at litc@lclark.edu. We will enter you into the $15 gift card giveaway to Dairy Queen. Did you all
And
want to talk anything else about the questions that were
uh,
presented?
no, just thank you so much for being an engaged audience. We really
Oh, wait,
appreciate it. Yeah.
sorry. There's a question from a student. It says, what happens when you pay someone to do your taxes and they make an error? That's an excellent question. Um, First and foremost, you can correct the errors by filing an amended return. So you can always go back and amend your return. I always is maybe an overstatement. You have, in order to claim a credit, you have 3 years from the due date of the return to do that, and 2 years from any payments you've made. But to correct the return to make it look like it should have been done, you can amend the return. If you suspect fraud or the tax, um, if the tax preparer actually like harmed you and did you wrong, then there's a procedure for um, kind of correcting that. It's called preparer misconduct application. And basically what you can do is you can tell the IRS that you've been a victim of fraud, and then the IRS can help go back and correct everything and make sure that you aren't suffering because of that. It does take a long time, and the procedure takes, I've had a few of those cases, and it takes years to resolve, but we can go that route. And then if there's a pattern and practice of a preparer that's doing fraud on taxpayers, then you can report it to the authorities. And we've had clients that are witnesses in those cases in which the tax preparers get prosecuted for misconduct. So it can become a big deal.
Right.
Great
And so,
question.
yeah, that's a really great question. And so, yeah, there's ways to amend your tax return. And then on the front end, remember you can always amend your W-4 as well. And that's an easier process than amending the return. Um, and then also for the students, if they tuned in a little bit later, the full presentation will be available after, if you are so inclined to watch the entire presentation. It has a lot of great info um, as you all start looking for possibly summer jobs or jobs after graduation. So,
There was another question, but I think you answered it, Abigail. It was, what happens if you make a mistake on the W-4? And then that one, Abigail, is correct. You just can redo your W-4. And
mhm.
however, if the problem isn't noticed, for example, for an entire tax year, and it results in you owing a lot of tax, for example, there are ways in which we can, on the back end, resolve that. We can, you can help get into a payment plan. There's something called an offer in compromise, where if you owe a lot of tax debt, you can make an offer to the IRS to resolve the tax debt for less than what you owe. Also, if you are suffering from financial hardship, you can go into what's called currently not collectible, which is a status with the IRS that just means the IRS isn't going to come after you if you're suffering from financial hardship. But you are going to want to get that W-4 corrected as soon as possible.
Yeah, awesome.
Let's
Well,
see. Oh, there's a new comment. This is okay. I have to say, this is the one presentation where there's so many comments and questions. So lots of engagement. That's it. I think that's it. So yes,
awesome.
as Abigail mentioned, the full presentation will be on Facebook and you can come back and review it if you'd like. Any final thoughts or words from our presenters?
No, just thanks again for being such a great audience. We really enjoyed sharing this information with you. Hopefully, the gifts made it a little bit more engaging. But yeah, as we said, really important information in a way that you can be an active taxpayer. So,
Yes, thank you for listening to us, and hopefully it was helpful.
yeah, thank you.